We interrupt our regularly scheduled programming and our very serious deep dive into the Fed series to bring you this tariff special.
That's right. You voted for this episode on Instagram. We pulled an all-nighter to deliver the goods.
Because when economic policy breaks, so does our sleep schedules, apparently. So let's get into what these new tariffs really mean for the markets and your money.
The markets are terrified, as we said last week.
Are.
It ties
That's
in.
Great. It does. It does. So on April 2nd, 2025, the Trump administration shook global markets by announcing sweeping new tariffs, a 10% baseline on all U.S. imports, and even steeper rates on certain countries, 34% on China, 20% on the European Union.
Wait, like on everything we import? That sounds huge. What's the goal here?
Well, the current administration called it Liberation Day, but economically, it's more like Complication Day. These moves pushed U.S. tariff levels to the highest point we've seen since the early 1900s.
Wow. And how does that ripple through the market? I mean, are we talking higher prices, job losses, currency drama?
All of the above, Jesse. So I think in today's episode, we should break down how tariffs affect the stock market, how it could affect inflation, the Fed's reaction even, and the US dollar. Plus, let's talk about what sectors tend to do well in this type of environment or those that could suffer when trade tensions rise.
Basically, if tariffs are back, your portfolio needs a strategy. So let's get into it.
Let's do.
You're listening to MakeHer, the self-directed investing education podcast that breaks down how the stock market works in a way that makes it actually make sense from her perspective.
That's us. We're her. This podcast is teacher-learner style. I'm Jess Inskip. I act as the teacher. I've worked in the self-directed investing space for over 15 years now and talk markets on CNBC, Fox Business, Yahoo Finance, the Schwab Network, and Bloomberg.
And I'm Jessie Denwy. My job is to make sure that everything actually makes sense, which means I'm not afraid to ask the hard questions we're all thinking, and I keep Jess out of financial jargon land.
Yes, because she's literally learning live. And it's so beautiful to see. Together, we're on a mission to make you fin-fluent and not fin-fluenced.
All right, Jess, what is on the agenda for today?
So today, we need to unpack the 2025 tariffs that just sent the market down over 1,000 points.
Yeah. Yikes.
Yes. What they can potentially mean for inflation. Keywords potential. There's a lot of unknowns here. Jobs, the Fed, the dollar, and your portfolio. We'll walk through how markets are reacting and what history tells us about past trade wars. That's going to be a fun little takeaway. There are a lot of unknowns, but we're going to focus on as many knowns as we can. As in, we don't know how long these tariffs are going to be in place. We don't know what retaliation is going to be. There so many unknowns.
Yeah, and so far this year, Trump has been like kind of going back and forth on everything. So I guess we'll see. Like, we really can't predict what's going to happen.
No. And since it is a negotiation tactic, quote unquote, that says to me that they can't be implemented too long. That's just my personal thought. And the market is not pricing that in. If the market thought it was going to be much longer, I think we would have a bigger sell-off. But nonetheless, I digress. Let's talk about what we know.
Okay.
So let's talk about the economic ripple effects of these tariffs, specifically inflation and employment, which are the two things the Federal Reserve care about the most. So this does tie into our deep dive series.
Ah, yes, because I remember the Fed has that dual mandate, something about keeping prices stable and making sure people have jobs, right?
Exactly. Price stability and maximum employment, but tariffs throw a wrench into both because here's why. Tariffs are basically a tax on imports. That means foreign goods are suddenly more expensive. Everything from raw materials to finished products costs more, and those costs usually get passed on to consumers. And there's a caveat to that too. It could be passed on to consumers as in they raise the price, or if the company absorbs it, that means their cost to operate is going higher, and that could lead to layoffs as well. So we don't know how that's going to happen.
Yeah, we definitely don't want either of those things, but
No, it's not good.
yeah. Okay, so we're talking about higher prices at the store.
Yes. So you might start to see price hikes on things like electronics, appliances, maybe even groceries, depending on the supply chain, because this is like a supply chain disruption
Mm.
all at once. And Fed officials are already warning inflation is going to tick up in the near term because of these tariffs, but maybe they're transitory.
That's inflation, right? So doesn't that mean the Fed is possibly going to raise rates again?
That's what makes this so tricky because while inflation's going up, the economy might actually slow down
Mm.
at the same time. So tariffs, they can mess with supply chains and raise input costs for businesses. So companies might cut back on spending, hiring, or even start laying off people. And that could push unemployment higher, like the balance on that dual mandate.
Oh, is that what stagflation means then? Like prices are rising, but the economy is not growing?
Exactly. It's like a tug of war. Inflation pulling one way and weakening growth pulling the other. And the Fed is stuck right in the middle because that's their dual mandate. They're not focused on how the stock market's doing, they're focused purely on price stability and maximum employment. So if they raise rates to fight inflation, they risk making the job market worse. But if they cut rates to help jobs to stimulate the economy, they might make inflation worse.
So it's stagflation because it's like stagnant. Like we're having inflation, but the economy is stagnant. Is that
It's slow growth to no growth.
okay?
Mm-hmm.
That sounds like a really hard call for Papa Powell to make.
It is. And there's a whole committee, so we're hearing a lot from them.
Mm.
Fed Governor Lisa Cook, for example, she said inflation progress will stall in the near term. So they've expected that. Remember, they're cool, calm, and calculated. We had
Mm.
Chill Powell.
Yeah,
And
Chill Powell. That's right.
yes, and we
He's a
actually have
raven,
he is a raven.
not a dove, a raven.
Exactly. Not a hawk, yes. And
Oh yeah.
the unemployment, it's likely to rise a bit over the course of the year, quote unquote. So
Mm.
basically, the risks are now skewed, higher inflation, slower growth, but that makes monetary policy way more complicated.
Did he say that it's likely to rise a bit over the, like that was his word?
Yeah, he did say that. He
A
expects
bit.
that. He has to look at the totality of the data. We don't know how long, all of these other factors that go into it. And that's why he called it transitory, as in it might hit inflation in the short term really quickly, but then that might dissipate.
Oh, that's right. Fed Powell said
Hmm.
transitory, but you're saying Fed Governor Lisa Cook is saying it might rise a bit over the course of the year.
That's right.
Okay.
Hmm.
So what's the Fed doing now then? Are they going to raise rates, cut rates? Do we know?
Well, from the last meeting, at the moment, they're pausing. We have that. The
Mm-hmm.
message loud and clear, watch the data. The Fed doesn't want to overreact in either direction. Usually, in his past meetings, three pieces of data is what makes a trend. So one piece of data is not going to be indicative of one. But markets, they're already pricing in more cuts later this year, about 80 basis points now, which is more than before the tariffs were announced. So that means the market thinks that it was priced more for a soft landing and now it's pricing more for the risk of unemployment, recessionary things.
When you say 80 basis points, you're talking about $80 or what?
No, the like 0.8%.
Of the, oh, we're talking about
The
rate cuts. So
yeah, the
markets
Fed.
are pricing in more rate cuts. So they're assuming a 0.8% rate cut.
That's right. Yes.
Okay.
Hmm.
So people think that the Fed will cut rates later in the year, is what it sounds like.
Yes, but cautiously. If inflation keeps climbing because of these tariff driven price hikes, the Fed might hesitate to cut aggressively. But remember, one piece of data does not make a trend. They
Mm.
don't want to fuel more inflation while trying to avoid a recession. It's a lose-lose setup unless the data gives them a clear path.
Yeah. So bottom line, it's a mess.
Yes, that's a technical term, I suppose.
The human world, it's a mess, to quote
It
Sebastian from Little
is.
Mermaid.
Oh, I love that. It's a good one. It is a mess. Probably better under the sea, to be fair. But
Yeah.
tariffs, they push inflation up and growth down. It almost does the Fed's job in a way because it might stop demand. Like raising interest rates makes the cost to borrow money so much more, the cost to carry money more. Tariffs makes things more expensive, so it could stop the demand side. So it's just an interesting dynamic.
Oh, it's interesting, like that you say that because the last time they hiked rates and we had like such high inflation a few years ago, we didn't really see growth stop. Like people still kept spending money. And like, we talked about how Pepsi raised their prices and people kept buying Pepsi, so like I'm curious to see if if tariffs this time are actually going to make a huge impact on the way consumers spend. Because
We'll
like
see.
the high interest rates didn't make as big of an impact as I guess the Fed may have thought they would, and that's why we had them for so long before
Well,
there was cuts.
is long and variable lags. It takes a while before you see it in the data.
Yeah, but we should be
That
seeing lags from the last whole like interest rate hike and cut cycle we just went through. So like wouldn't those lags become, and didn't you say that like there's more in credit debt per household now and things like that? Is like that the like lagging data we're seeing from before?
that is
Yeah.
it right there.
Yeah.
Which is that's what makes the Fed's job so hard. Investor, analyst, market participants, policymakers, they're all just trying to read the tea leaves now, like trying to understand what's going to happen. And you can't prepare if you don't know what's going to happen.
But what we do know is that uncertainty does not sit well with the markets.
Correct. Yes.
We at least know that. So,
Sure
okay.
doesn't.
And, I guess today we saw some of that take effect. But
Yes, you did.
All right. So just to recap, tariffs are like a tax on imports, which makes stuff more expensive and drives inflation up. But at the same time, they slow down the economy and hurt jobs. That puts the Fed in a tough spot, stuck between rising prices and rising unemployment. And for now, they're hitting pause and watching the data. Right?
That's right. Yep.
Okay.
All right. So let's talk about how these tariffs are hitting the US dollar and the Treasury market, two massive parts of the financial system that don't always get the spotlight, but they definitely react when big policy shifts happen.
Yeah, I feel like we always hear the dollar's up, the US dollar is up. Treasury yields are falling, but I don't always know what that means. So, what happened right after the tariffs were announced?
Great question. So it's interesting. Usually, in times of uncertainty, the US dollar strengthens. It's seen as a safe haven. But this time, the opposite happened. The dollar dropped fast, down about 2% today and over 6% for the year so far.
One question. When it's down 2%, what does that mean? Like it's worth like a dollar is now worth 80 cents? Or no, 2%, 98 cents?
No, kind of. So it's the dollar index and it's weighted with the different type of currencies. So it's heavily in the euro and the yen actually. So it's relative to all that. So it was like 110. I think it's 101 to 102 right now.
I wouldn't even know how to look at what the dollar is worth right now. You just look at an index, like the USD index.
Exactly. USD index is what
cool.
you would want to look at to understand that. Yes.
Okay.
Great question.
So the US is still a safe bet or not?
Well, normally it is, but markets, this is the way that they're reacting. Now see the US as one of the losers in this potential trade war. Tariffs slow down growth, and if growth stalls, the Fed might cut rates. That lowers the return on the dollar. This is global investors are starting to look elsewhere. This is how we can see that there's buying of US Treasuries because yields are going down. They work on a seesaw. But it's not from foreign investors. It's definitely domestically because foreign investors need to buy dollars before they go into treasuries.
Oh, that's right.
Mm-hmm.
Okay. Yep. That makes sense. So if the Fed cuts rates, the dollar becomes less attractive to hold for foreign investors?
Yeah, absolutely.
Okay.
Because the treasuries are less attractive.
Yeah.
Right? Yeah, exactly. And there's another inflation little twist here. A weaker dollar also makes imports more expensive. You've got inflation from two sides, tariffs and currency depreciation.
Ooh, so wait, then what's happening with the bond market?
So treasuries did what they always do in times of panic, rallied hard, as in the price rallied hard. Lots of buyers puts pressure on the price upwards. Yields went down because it's the inverse. So investors rushed into bonds for safety, which pushed prices up and yields down. The 10-year treasury yield, we watch that one so closely because it's tied to our mortgages, dropped to 4.04%, its lowest level since October of last year.
So bond prices are they go up when people get scared. Is that the correlation?
Exactly, because they're buying it. It's the bond price goes up. That means it's being bought. It's called a flight to safety, but the rally may not last forever because even though recession fears are dominating right now and probably accelerated because of social media, there's still big concerns about inflation and how much debt the U.S. is issuing.
Hold up. So that's what flight to safety means. I hear you say that all the time, and I kept forgetting to ask you. So flight to safety is people flocking towards treasuries and bonds because it's a safer investment than the stock market. That's what flight to safety means.
Usually gold too, utilities and
Yes,
staple stocks as
we've
well.
definitely been seeing. I've been seeing headlines about gold prices soaring and things like that.
Yes.
Yes. Okay. And then you mentioned the U.S. debt, so deficits. We've been hearing about that a lot lately too.
Right. The US is running a massive budget deficit, which means we need to issue a ton of treasuries to fund it. That's that whole market. That increases the supply of bonds. And when supply goes up without matching demand, yields can rise again.
Wait, if supply is not matching demand, why would yields go up? Like wouldn't they go up when there's more demand?
They would go up if there's more demand. You need somebody to buy it. So that's why. If
But
it's
it's
not
not
matching
matching
demand.
demand.
Exactly. So if that happens because of the increasing deficit, then that means yields can rise again because they're going to issue a bunch of treasuries. And if no one's buying the treasuries, who's going to buy them? The Fed? That's an open question, and that's an unknown, and a really great observation you just made.
Oh, okay. All right.
Mhm.
So people might be buying those now because they're scared, but longer term, they might pull back depending on like what happens.
Yeah, especially if inflation stays high or if foreign investors stop buying treasuries. And there's even talk of changing banking rules to encourage U.S. banks to hold more treasuries just to keep demand up. That's how serious of a problem this is.
Okay, so let me see if I got this right. The US dollar is falling because people think the US will get hit harder in a trade war with all these tariffs, and the Fed might cut rates. Treasuries are rallying for now because of recession fears, but too much debt and sticky inflation could reverse that later.
Perfect summary. It's a tug of war between safety buying, inflation pressures, and the sheer amount of debt we have to fund. And it's all interconnected with how global investors feel about the US economy.
Bottom line, right after the tariffs, the dollar dropped. Treasuries rallied, but neither move is guaranteed to last. And the market's reacting to fear right now, but longer term, inflation and deficits are lurking in the background. Basically, keep your eye on the tug of war that's happening.
Yes.
The tug-of-trade-war. Okay.
That's a good one. I like it. All right. So we covered the macro stuff: inflation, the Fed, the dollar, treasuries. Now let's look at what this means for you, the self-directed investor.
Yes, because honestly, every time there's a market shock, I just want to know, should I do anything with my portfolio like right now to capitalize?
Yeah. Totally fair. That's the question that everybody wants answered, to be honest.
Yeah. But if this is a bigger shift, like structurally, I guess, what's the long-term thinking?
So we could be entering this de-globalization phase. That means supply chains moving onshore, which I think is what this administration is trying to do. More U.S. production, which is going to take so much time to actually implement. But there are lots of data centers, talks being built in the US. You can see it. So a longer term investor might want to look at companies benefiting from reshoring, like manufacturing equipment makers, logistic firms, or domestic infrastructure players. And we've talked a lot about that actually on our stock market update.
That's right. And yeah, that makes sense, I guess. Like if we're building factories here instead of overseas, somebody has to supply the tools and tech.
Exactly. Also important right now is quality and pricing power. In a high cost, low growth world, companies with strong brands or essential products can pass on price increases without losing customers. So think mega cap companies with clean balance sheets and a global reach. The first one that comes to mind to me is literally Costco, has
Huh.
pricing power and is quality.
I was thinking
Not
like
advice.
P&G, like because
Sure.
yeah, like toothpaste, all the products we use. I mean, unless you can like find local or like the smaller brands, but it's harder to find those. And like companies like P&G own everything. So yeah, like those companies you might not, or like remember when we had shrinkflation happen? Like we might see that
Hmm.
again
Let's hope not.
without realizing it, but now we're more aware of it. So it's not just about chasing hype, it's about resilience. We talked about like the resilient consumer before, and that's kind of what we're going to have to look at again.
Yeah, the resilient consumer and then how that translates into the resilient investor, I suppose. Um, but some big companies and analysts, they really like and still like large cap US stocks in this environment, especially those riding durable themes like AI or innovation because they emphasize selectivity. And I'm still on this AI train. I really am
Mm.
because it helps the bottom line. And if there's so much other things in play, if you think about the immigration issue, losing labor supply, you have to help your bottom line. And that's through automation and efficiencies. And the best way to do that right now is artificial intelligence.
And like we're really just getting started with AI. It's getting more and more
Yes.
sophisticated like all the time. I mean, it's like growing fast. So we're probably just going to keep seeing it grow into more spaces, I'm sure.
Yeah.
So what about international investing then?
Yeah. So we haven't talked about that very much, but it is interesting. The sell off first went overseas. Like the sell off in tech went to lots of global markets. So it's very important that that's kind of happened already. It's still important, just more selective. Some countries not affected by tariffs might gain trade flows, but you want to be mindful of exposure and maybe look at funds or strategies that aren't tied to one market's direction, like global macro or market neutral funds.
Yeah, I don't think we really have talked about international investing. Now that I think about it, we've like focused a lot on US investing. So
Mm-hmm.
yeah, and we might need to do an episode on that because I don't really know where to even look at the global macro or market neutral funds you're talking about on a global level. So that might be a good future episode. But yeah,
Yeah.
like it's not all or nothing. It's adjust and rebalance, right?
Yeah, exactly. Stay flexible. If trade tensions ease, that could spark a relief rally. But if things drag on, you may want a more old school portfolio, which is dividend stocks, hard assets, and inflation hedges. People are looking for yield as yields are down. People are looking for lower beta because volatility is up. That means dividend stocks, they have a lower beta and offer you some yield, things like that.
All dividend stocks have a lower beta.
Not all of them, but most of them
Okay.
do.
Okay,
Because
that's cool.
they're not growth oriented, right? They're not
Yeah.
they're not reinvesting their profits back into the company to grow more. They're distributing to shareholders.
Yeah, that makes sense. Okay.
Yeah.
So to wrap this part up, in short term, think defense. That's gold, bonds, recession-proof sectors, like things you need to buy every day that you can't survive without.
Mhm.
And then in the long term, look for structural winners like US manufacturers and companies with pricing power. Stay diversified, stay flexible, and don't try to time it perfectly because remember, you cannot time the market, but you can be prepared.
That's right. And that's what we're doing today. And I will say the short term, that a lot of that's already happened. So we're going to shift to long term now.
Okay, so we've talked about how tariffs are hitting inflation, the Fed, the dollar, treasuries, and investors like us. But this isn't the first time the US has tried tariffs like this, right? You mentioned earlier something about the 1920s or 30s.
Oh yeah, we're going back in time, so not even close. History doesn't repeat, but there is a rhyme or there is an echo.
Hmm.
I love that line.
Oh,
I
that's
say that with
interesting. Yeah, because
yeah.
you hear history repeats itself, but maybe not exactly. I like the echo. There's an echo from the past.
Yes, it's a pattern recognition. When we get into technical analysis, I always start with that, but we're not
Ooh.
there yet.
Okay,
Yes,
fine.
I love it, love it.
Get me
Because
there.
Past performance is not indicative of future results.
That's right.
Yes. Let's look back at some major tariff episodes and what we can learn from them today.
Okay.
So let's start with the big one, the Smoot-Hawley Tariff Act of 1930. This is the cautionary tale every economist loves to bring up. Congress raised tariffs on over 20,000 imported goods to protect American industries at the start of the Great Depression. But instead of helping, it kicked off a global trade war. Countries retaliated, world trade collapsed by 2/3, and the downturn deepened.
2/3. That sounds like a lot.
Yeah, it is massive, and it was devastating. U.S. exports got crushed, and the stock market had already started crashing in anticipation. Investors saw it coming and bailed, which means sell-off. Key lesson here, broad tariffs during fragile economic times, because this was a fragile economic times, equals a bad idea. Retaliation is basically guaranteed, and everyone ends up worse off. And what scares me about that is we're in fragile economic times now.
We are. We're maybe not being a Great Depression, but something's a brewing.
Fragility.
Something's going on. Yeah.
Fragility.
We're a little, yeah. Okay, well, that was one piece of history. Yeah.
So next up, President Nixon in 1971. He imposed a temporary 10% import surcharge to pressure trading partners into currency negotiations. It worked short term. The US dollar was devalued and the stock market actually rose initially.
Okay, so tariffs can work, kind of?
Sometimes, if they're temporary and part of a bigger strategy. But even then, the 1970s brought massive, massive inflation and stagflation. It proved that tariffs alone don't fix economic imbalances. You need sound monetary policy too. And remember, monetary policy changes, but this is the Volcker era that we need to revisit. That's part of our Fed deep dive, which is so relevant.
Yeah, that's right. We talked about that last week. Okay.
Yep. So then there's the 2002 steel tariffs under President George W. Bush, up to 30% on foreign steel to protect domestic producers.
Did that work?
So for steel makers, kind of, but it backfired hard for everyone else. Industries that use steel, like auto, construction, and machinery, they saw higher cost. And around 475,000 U.S. manufacturing jobs were lost.
It's a lot.
Well, they couldn't pass on the price increases to the consumers. And so if they absorb it, layoffs happen. So more than the total number of steelworkers in the country. Plus, the stock market lost trillions in market cap before the tariffs were repealed, early under pressure from the World Trade Organization and Europe.
So even targeted tariffs can cause a ripple effect.
Exactly. Protecting one industry often hurts many others downstream.
I mean, that
In
kind
this
of makes
scenario.
sense. Like, why aren't we learning from these history lessons? Anyway, let's move on to Trump.
Yeah. So, well, here's our most recent, and it was Trump 1.0. So fast forward to Trump's first term. Tariffs were back, especially on China, but also on steel, solar panels, washing machines, you name it.
I remember the headlines like trade war this, trade deal that.
Yes. And our deep dive episode we did on that as
We
well.
did. Mm-hmm.
Yes. And while the economy didn't collapse, research shows that U.S. consumers and businesses bore most of the costs. Prices went up, growth slowed, business investment pulled back, not just from the tariffs themselves, but the uncertainty around them. And dryers and appliances are still expensive.
Yeah. Which is annoying.
Mm-hmm.
So I guess like that had a long-term lasting effect. And even the fear of more tariffs was enough to make companies hit pause.
Yeah. And so this is where I think that resilient and lean and agile companies and consumers are coming into place, because even right now, people are front running it, as in people are buying a lot more inventory in preparation for these tariffs. So there's going to be excess inventory, which is why it's so important to continue that Fed deep dive, because we're starting with excess inventory and things that happened to cause COVID is very similar, or
Oh,
through
yeah.
the duration of inflation is kind of similar in a way.
Yeah.
Hmm. But the Fed cut rates in 2019 to offset the drag before COVID. The market was super volatile. Every time a new tariff was announced, stocks dipped. Every time a deal looked possible, markets bounced. Because the stock market, is a very overly emotional man with an anxious attachment style.
I loved that really you did.
That's great. Yeah.
Yes. Anxious attachment, never a good look.
It's what's happening right now. You can see it's freaking out. Like it's
It is.
implemented. Oh man. So now let's
It's
look at
out of
today.
control. It's lost control and it's trying to get it back desperately.
It is freaking out. So now in 2025, we're seeing the highest US tariffs since the Great Depression.
Wow.
A blanket 10% on all imports, plus steep add-ons for China and the EU.
So we're back to that Smoot-Hawley era.
Kind of, in some ways, yeah. So the scope is broad, the stakes are high. And so far, we're seeing the same early symptoms: inflation pressure, falling confidence, that soft data, market sell offs, and rising recession fears. All soft data.
Okay, but the Fed today is at least more prepared than it was in the 1930s. Like they take all that into consideration, I'm sure. Like at least they're paying attention to history, I would imagine.
Yeah. So just like companies are being resilient and adjusting, the Fed is too. They adjust their monetary policy, which is why we have to continue that series. It's so important. We have better data, we have more responsive central banks and global institutions that might help negotiate a path forward. But the key lessons, they still hold. All right.
Okay, let's do some historical takeaways.
Yes.
Okay.
So, really quick historical cheat sheet. Tariffs often backfire. They raise costs, hurt more jobs, and they help and can trigger retaliation. They fuel inflation. Imported goods get pricier, and that sticks around. Markets hate uncertainty. Stocks usually sell off on tariff news, but rebound when pressure eases. Policy reversals happen. Economic pain or political fallout can force tariffs to be rolled back, sometimes earlier than expected. And when that happens, markets can bounce. And I guess no free lunch, quote unquote, even protected sectors often don't see lasting benefits.
So we've been here before, and while the details change, the story kind of stays the same. That echo from the past, if you will.
Yes, we just hear it reverberating. So tariffs are a blunt instrument. They can work short term, especially as a bargaining chip, which seems what is happening here. That's what the markets think. Let's hope so. But long term, they can often cause way more harm than good. So investors should brace for volatility, uncertainty. That's what it's going to be. But also watch for opportunities when the policy winds shift.
If someone wants to send this episode to the current administration, that would be great for everyone. So, bottom line, history tells us that tariffs are risky. Markets react fast to that news, and flexibility is key for investors. But if you're investing in a tariff world, keep your eyes open, stay diversified. We have a whole episode on diversification for your portfolio. And maybe brush up on your history a little, because I honestly didn't know anything about those historical. I mean, I obviously knew about the Great Depression, but like I didn't know all of this tariff history. So, really good to know in this case.
Mm-hmm.
So, as a wrap up, let's look at the big picture. The 2025 tariffs are big, bold, and risky, and history tells us the fallout could include higher inflation, slower growth, and a choppier market. But for investors, that means it's time to stay focused on quality, hedge your risks, and stay flexible. And most importantly, keep that long-term mindset. Markets don't like uncertainty, but they do adapt. And remember, time in the market is always better than trying to time the market. So,
Absolutely. On a day like today, honestly, I sat on my hands. I didn't buy, I didn't sell, I didn't do anything. We knew there would be volatility, already positioned the way we need to. Now we're going to think long term. And I love what you said. Markets don't like uncertainty, but they do adapt. That's a great statement. So, at the end of the day, tariffs are just one piece of this big stock market puzzle that we keep putting together. But that one piece has really big ripple effects. It's probably like that annoying one, that you can't fit it like right because it's like weird.
Yeah.
But it matters how you respond with knowledge, confidence, and a strategy that flexes with the times.
And if anything, if like this event, like seeing this happen, does nothing but make you look at your portfolio and make sure you are diversified because maybe you weren't and you're more heavily into stocks and ETFs and things, and it's getting you to start thinking about like, oh, I need to be diversified, then good. Look at how to diversify your portfolio or where you want to put your balance in the little pie chart. You can take quizzes and things at your brokerage firm to figure that out, but diversification is definitely key. And this might be a good kind of reminder to look at your portfolio and stay diversified. Also, it's time for that quarterly check-in. So we do need to think about that. Make sure you're looking at that smile sheet that we did back in January and see where you're at. And you might want to add a square for portfolio diversification. It's a good time to look at it.
I love that.
Anyway, yeah. So anyway, we're here to help you break all this down so you can make smart moves even in a complicated market.
Yes, I think you have such a good point because all these self-proclaimed financial influencers that learned investing learned through a bull market.
Yeah.
They just did. Yes, keep investing in dollar cost averaging into your ETFs. It's absolutely fine, but you can make better moves. And we're going to tell you more than that. That's all. So that's it for today's episode. If you're loving the pod so far, please leave us a review or a 5-star rating if you're so inclined. It's the best way you can help us.
And if you learned something new, share it with a friend, hit subscribe, and don't forget, you can send us your questions anytime. We're here to make the markets make sense. And make sure you follow Jess's social channels that are linked because she makes great content around this like every day.
Oh, I try.
Remember, when you build knowledge,
you break down barriers.
Remember, investing involves risk. There is always potential to lose money when investing in securities. MakeHer provides educational content and resources for informational purposes only. We are not registered financial advisors and do not provide personalized investment advice. Any information provided by MakeHer on our website or podcast is not intended to be a substitute for professional financial advice. MakeHer is not liable for any investment decisions made based on our content.